The IRS expects 168 million tax returns from Americans this year. We're in the thick of tax season. Whether you're an individual or a business owner, it is that time. I'm gonna be going over 5 key things you need to know before filing your taxes. I'm Matt Franchina, AKA the People's Advisor. For the last 16 years, I've been simplifying complex planning, helping you protect your health, build your wealth, and secure your legacy. Let's get into it. So how do you know if you even need to file your taxes this year? Well, if in 2024, as a single individual, you made more than $14,600, you're gonna need to file. As a married couple who's filing joint, if you made more than $29,200, or if you file as head of household and made more than $21,900, you're gonna need to file. Now, if you're self-employed, you have to file if you made anything over $400. In America, they're expecting 1.5 million people are gonna miss out on tax returns. Why? Because there's a lot of people who ended up making less than the threshold to file and think they don't need to. But here's the tip. If you did make less, but you worked, it's very likely that your employer deducted taxes from your checks. The only way for you to get that back is to file, use the standard deduction, and eliminate that income, causing them to owe you a return. So now's about that time. You're probably going into your closet, grabbing that box full of receipts, all those envelopes that you've gotten all year for tax purposes, and you're ready to go, right? No, I'm just kidding. Don't do that. We're in the digital age. You don't need all that paper anymore. Really, what do you need to have when you go prepared to get your taxes done? Now, I'm not a licensed tax professional. I'm a financial advisor. So I got a list here. Let me just share with you some of the common things, which would start with, if you're employed, W-2 from your employer. Then we go into 1099s. Now, there's lots of 1099s. In the description below, we put a list for you, so you can go down there and check it out. But the 3 most common are gonna be a 1099 NEC for non-employer compensation. That's your side gigs or your self-employment income. Your 1099 DIV, which is gonna be dividends on investments, and your 1099-R, which would be if you took any money out of retirement accounts, IRAs, 401ks, things like that. If you own a home, you're gonna want something that shows the mortgage interest you paid, because you'll get to write off some of that. Student loans, if you're paying some of those down, then definitely want a statement from there. Charitable contributions and medical expenses. So if you made a lot of charitable contributions or you had big medical expenses, you might want to itemize. Just depends on how much it added up to, but you want to grab all of that since your tax person's not going to know that off the top of their head, and my screen went black. Home office deductions. In this world of remote work, many of us are working from home. So remember, the square footage of the dedicated workspace can be written off. So you want to figure that out. How many square feet is the house? How many square feet is the room? Is it dedicated? Be ready with those numbers. For you business owners out there, definitely need to have tracked the business income, and you need to know all those expenses. Look, I've been a business owner or self-employed for 16 years. I understand the value of write-offs, and let me tell you, it pains me to know that there were years where I was not doing this as effectively. There's all kinds of really cool write-offs available to you as a business owner, which we'll get into more in another video, but I just want to put out there, everything you spent money on that could be tied to that business is probably a write-off. You heard me throw around the word standard deduction. So how do you know if you should choose the standard deduction or itemize? Well, first off, if you're getting a tax professional to do your taxes, they're gonna tell you. Here's the basics. The standard deduction is equal to the amount of money that you need to cross over in earnings to need to file. So it's $14,600 for a single individual, $29,200 if you're married filing joint, and if you're filing as head of household, it's $21,900. Now, if you're over 65 and filing, you get a little bonus. For single filers, you get an extra $1,950 to your standard deduction. And if you're married filing joint, it's $1,550 per person. Get a little bit more income written off. So how do you know if you should take the deduction or itemize? Well, if you take all of your itemizable things like charitable donations and medical expenses and you add all that up and it's less than the standard deduction, then you just take the standard deduction. You don't get to combine them together, it's either or. Now, 90% of Americans tend to take the standard deduction, especially these years where it's gotten so high. A lot of times it's pretty hard to write off enough things itemized to cross over that limit. If you're a business owner, you get to take the standard deduction and you can itemize and deduct qualified business expenses. So just remember, add up all those expenses, see what qualifies that it could be itemized, and then just do the math. If it crosses over, maybe you itemize. If not, standard deduction, easy as that. So most of you know the deadline already, but I'll remind you, this year it is April 15th. You must file your taxes or file an extension by that date. If you file an extension, this pushes you out all the way until October 15th to get that done. Now, if you have an S Corp, an LLC, or a partnership, those are on a different timeline. They're due a little earlier. March 15th is the deadline, and if you file an extension, they become due September 15th, so a little bit earlier for you business filers. All right, so get all this stuff in order so you can file quickly. The sooner you file, the faster you get your return back. Let's stop and talk about returns for a second. I got a bone to pick with tax returns. Americans are so fired up and excited to get their tax return like it's this bonus. In all reality, the tax return is your money that you overpaid to the federal government and the state. They kept it as a loan all year long, and now they're just giving it back to you because you proved to them you paid too much. Wouldn't it have been better to just have gotten more money on your paycheck all year long? I'm a financial advisor. These are the things that go through my head. You could have done a lot with that money, whether it was invested or paid down some debt that's costing you. Putting it into the hands of the government so they can just send it back is not the right move. We got a lot more videos out. Subscribe, comment, like, all the good stuff. See you next time.